What's up, everybody? I'm Logan Moody. This is The Contrarian. Today I'll be talking about the recent pivot by the Bank of England just a couple weeks ago, as well as the Bank of Japan recently, and how this will be a major contributing factor as to why the Federal Reserve will be not far behind to follow in terms of also pivoting away from their tightening cycle. Now, a common theme over the last few months that I've been talking about is the Fed has already way overdone their tightening cycle. Now, that is not evident in CPI yet or in employment yet. If inflation were already, say, 3%, 2% where they wanted it, of course the Fed would have an excuse to pivot away, and they would pivot away. But inflation is a very lagging indicator. Also, employment is as well. But indicators that are more perhaps current with the market indicate that the economy has slowed very dramatically. So anything from the bullwhip effect, showing inventories that became very bloated, all of a sudden retailers are hardly ordering any new inventory. They're trying to sell off these bloated inventory levels. Same thing with the housing market. So there's a lot of current, more current indicators than what the Fed perhaps looks at that is already indicating that inflation will come down fairly dramatically, and unemployment also could go up as a result. So the economy has already been very dramatically affected by the Fed's tightening cycle, even though it hasn't quite become apparent yet with regards to inflation and unemployment, which unfortunately is what they say they are bound to. So that unfortunately keeps the Fed in their narrative that they need to keep tightening, even though, in my opinion, it's not that necessary for them to do so. In fact, they actually have done the most dramatic tightening cycle in history in terms of the rate of change, where they went from to where they are now, even though nominal rates have not gone anywhere close to previous levels where they were. The rate of change of increase has been the most aggressive that it ever has been in modern history. So the Fed has already way overdone the tightening, and right now the bond market is signaling that the entire system is on the verge of collapse. And the Bank of England and Bank of Japan pivoting will be a very important factor, in my opinion, for the Fed to also pivot. Now, foreign holders of treasuries, such as Russia and China, already were getting rid of their U.S. Treasury holdings for different reasons. Obviously, Russia, they're effectively kind of an enemy of the U.S. right now. Of course, they're not going to be buying more treasuries. China as well, to a lesser degree, they're also pivoting away from holding U.S. Treasuries, pivoting into other assets. So this has sent bond yields skyrocketing, and as a result, bond prices have gone down very, very dramatically. In fact, the traditional 60-40 portfolio, I believe this year has had the worst year on record. So that says something. Even though the stock market only gone down 30-40% maybe, looking on the most overvalued tech stocks out there, even though that's only gone down 30-40% maybe, bond market has suffered way, way worse. And so this has hurt investors in a much greater way than it has even in the past. Looking at other major market crashes where the stock market did immensely poor, it crashed 70-80% maybe. The bond market typically actually will rally in such a situation, but that in this scenario, actually the bond market has done way worse than the stock market. So that does say something. Also, the bond yield curve is currently the most inverted that it's been in quite some time, over 20 years now, I believe. This is a very bad sign as well. It indicates investors are preferring to buy bond yields on the long end of the curve, not the short end. And so as a result, you have the 1 and 2 year yields going up very, very dramatically, even more so than the 10-year and 30 years. So that is a very ominous sign as well, just with how inverted the bond yield curve has become. And yet the Fed seems to still be somewhat oblivious to the fact that they have successfully destroyed the economy. Janet Yellen, I think, is starting to get the picture, although I wouldn't expect her to maybe get it entirely or to the degree that it is right now, because they are always so late to the game. But even last week, she said she was concerned about the drying up of liquidity in the bond market, and that is a very large understatement, in my opinion. Yes, there's a drying up of liquidity. In fact, it's going the exact opposite direction. So in my opinion, the Fed will have to step in in a major way if they want to keep the system intact. Now, if they don't pivot, then you end up with a scenario like the Great Reset. Now, maybe that's what the Fed is actually trying to do. I don't know. I would point to the Bank of England, Bank of Japan pivoting to maybe say that that's not in their agenda, that they are actually, in fact, just so far behind the curve that they are just this incompetent. But now I'll take a look at an article MarketWatch put out a few days ago, an opinion by Larry McDonald. The stock market is in trouble. That's because the bond market is very close to a crash. He says, don't assume the worst is over. There's talk of a policy pivot by the Federal Reserve as interest rates rise quickly and stocks keep falling. Both could continue, he's saying. The bond market dwarfs the stock market. Both have fallen this year, although the rise in interest rates has been worse for bond investors because of the inverse relationship between bond yields and bond prices. So because of that, the traditional 60-40 portfolio has actually had its worst year on record. Even though the stock market's only down 30% maybe, bonds are down so much more. Take a look at this. Pointing to the bond market turmoil in the UK, McDonald said government bonds with 0.5% coupons that mature in 2061 were trading at 97 cents to the dollar in December of last year, 2021, 58 cents in August, and as low as 24 cents over recent weeks. So that's what, a 75% crash that bond prices have had in the UK. That's disastrous, to say the least. So he's saying essentially that even though interest rates are not that high historically, the rate of change that they have undergone in the last year has been very dramatic. It has hurt bond prices very dramatically. And so basically getting to the chase, at the next FOMC meeting will be held November 1st through 2nd with a policy announcement on November 2nd. McDonald said that if the Federal Reserve raises the federal funds rate by another 100 basis points and continues its balance sheet reductions at current levels, they will crash the market. Now, it doesn't take a rocket scientist to figure this out, but it does mean a lot coming from someone like Larry McDonald. The basic mathematics holds true. That if the Fed is trying to trim their balance sheet as well as every other central bank is, dumping U.S. treasuries, that yes, the yields on these treasuries are going to go through the roof. The valuations of these treasuries is going to keep crashing. It's going to destroy the bond market. So he's saying that the Fed, the implied decision that they'll make is that they'll choose to pivot and step in as the only buyer left. Now, as I alluded to, another key factor that just developed recently is the recent pivot of the Bank of England and the Bank of Japan to pivot. Now, they also had tightening cycles that they attempted to undergo in recent months. Obviously, they were a lot less effective. Their economies were destroyed a lot more quickly because there was a lot more debt and leverage underneath the system. So Bank of England, Bank of Japan got nowhere as far as the Fed did in terms of their tightening cycle before they had to pivot. Bank of England, it was in response to the pensions effectively going bust. Bank of England had to step in and say, hey, we're not going to let this happen. We're going to pivot, go back to quantitative easing. Now, they never call it the same terminology as they previously did, but it's effectively a 180 pivot on both the Bank of England and Bank of Japan's part. Now, why this is so significant is not only has the dollar gone up in valuation relative to the yen and the pound very dramatically, but now the Bank of England and Bank of Japan have a responsibility to step in and buy their own treasuries. And what are they going to offload in order to add their own treasuries to their balance sheets? Well, my guess is going to be that they're going to offload that which is least helpful for them to hold. And currently that would be U.S. treasuries, because it's actually very, increasingly it's much more expensive for them to service these bonds, just with how much their respective currencies have dropped in relation to the dollar. So it's actually very advantageous for them right now to offload treasuries, as it's much more expensive for them to service this debt that they have, just with how the dollar has increased in value relative to these currencies. Now the dollar, like all fiat currencies, has gone down relative to goods and services with inflation. It's just gone down a lot less than the pound or the yen. So this is a key reason, just another nail in the coffin for the Fed's tightening cycle per se, is that the Bank of England, Bank of Japan suddenly also will likely become large sellers of US debt. And the plunging of the pound and the euro definitely played into this. All of a sudden, it's much more advantageous for them to offload this dollar-denominated debt. Now, these central banks suddenly had an increased responsibility to support their own system, whereas before they were attempting to fight inflation, which is, for England, is getting way out of control. Now, the Bank of England did pivot, even though inflation remained very high. So it is possible for a central bank to pivot, even though inflation remains high. They do prioritize keeping the underlying system intact, even if inflation remains high. So to me, this signals the Fed will not be far behind in terms of pivoting. Now, probably it's going to be in response to something systemically breaking, whether that's a US bank, whether that's a foreign bank. Credit Suisse, we've been hearing a lot of rumors about them recently, that they are becoming somewhat of a Lehman type of a bank out there. Even though it's not a US bank, all banks are so interconnected at this point with 2.3 quadrillion in derivatives. That's such a astronomically high number that it's very difficult to wrap your mind around. 2,300 trillion in derivatives is interconnecting all of these banks. So if one goes down, basically all of the other large ones go down as well. So even if it's not a US bank, if it's even a foreign bank, it's going to affect the US banks in a very significant way. So to me, this signals the Fed is not going to be far behind in their pivot. We're very close to either a pivot by all central banks, including the Fed, going back to QE, or an intentional killing of the current monetary system. So, which one is it? I obviously lean towards the Fed pivoting and all central banks pivoting. Now, this is not to say that the current systems stay alive much longer either. It is just a historical fact that all central banks eventually undergo hyperinflation, and that they eventually reset that way, that they never go the hard way and purposely collapse the system. So that would be a historical first for the Fed to do. It's not out of the question entirely, but I just obviously lean to them going the more, perhaps the more comfortable way. But definitely it's going to cause the same damage, if not more damage, but it's perhaps a little more comfortable for them. It delays it a little longer. But that's basically the summation of this video. I hope you guys enjoyed all of it. If it was a little scattered, that's because I actually just came back from a 20-mile run this morning. I'll put up some pictures from that run this morning, but just got to see some beautiful fall colors out here around Billings, Montana. But if the video was a little scattered all over the place, I just want to say I'm a little tired at this point. But all that being said, if you guys like this video, just consider hitting the thumbs up button, subscribing to the channel, and I hope to see you all again at some point.